Well, good evening, everybody. I'm sorry we're having to have this class tonight by pre-recorded video, but apparently the Zoom platform for CSU is not working tonight. So we are going to do it this way for now. What I have up on the screen is just apropos of our last session. You can see how quickly the law has changed in this area. We were talking about independent contractors and how they are in the process of constantly being evaluated by the government and categorized, mainly for tax purposes, as we said before, but it has an impact on the legal rules that we were talking about for management of an unincorporated entity. And you can see the way this works. They put out a notice requesting comments on the proposed rule, and you'll see here that they would like to adopt an economic reality test. Remember, we talked about how the IRS used to have a 20-point test for determining independent contractor status. They have boiled it down even further than we had talked about the other day, or at least proposing to boil it down further. And they want to try to, the new rule wants to identify and explain the two core factors, the nature and degree of the worker's control over the work. Remember, we talked about that as being definitive on that continuum of principal liability for agent's work, and the worker's opportunity to profit or loss, for profit or loss based on initiative and or investment. In other words, is the contractor running it like a business, where they have the ability to make even more money than what's being offered by the principal. So I put this up. It'll be the link will be on the website also. The actual rule is available to look at. It's very detailed, very long. But I wanted you to get a sense for the fact that the idea of categorization of these types of agency relationships is something that's subject to change even as we speak, literally. So FYI. Okay. In terms of tonight, we ended last week considering the liability of a principal for torts committed by its agent, along the spectrum of control ranging from the employer-employee relationship to an independent contractor relationship. And as we learned last week, the amount of control exercised by the principal seems to be the key determinant in analyzing these sorts of relationships and allocating liability. We also looked at cases in which plaintiffs asked the court to find the principal liable even when the agent was an independent contractor, because the contracted activity was considered, quote, inherently dangerous, quote, or quote, ultra hazardous, end quote. In all of these cases, we see the courts allocating liability or blame based on which party was in the best position to avoid or control the adverse outcome. This is a theme that goes through all of the cases involving unincorporated business entities. This week, we're going to transition from management and control of an unincorporated entity to the financial rights of partners, limited partners, members, or other stakeholders in unincorporated entities. This is arguably the most important issue to our clients, since they presumably formed this entity for the purpose of engaging in a business for profit. Remember the basic definition of a partnership: two people engaged in a business for profit. Let's talk first about partnerships. Financial rights in general with respect to general partnerships. There are three basic key default rules bearing on partners' financial rights. The first one: partners share equally in profits and in losses, or in whatever proportion they have agreed to share profits. I'm referring to UPA section 18A on page 620, which says, each partner shall be repaid his contributions, whether by way of capital or advances, to the partnership property, and share equally in the profits and surplus remaining after all liabilities are satisfied. The RUPA provision that states this basic default rule on equal allocation of profits and losses in a partnership is RUPA section 401B. This is our default rule regarding partners sharing equally in profits and losses. Second default rule. The only default provision for distribution of profits or divvying up of losses is upon dissolution and winding up of the partnership. I'm looking at UPA section 40 on page 627, which says, quote, in setting accounts between partners after dissolution, the following rules shall be observed subject to any agreement to the contrary. And what they're talking about here is specifically section B, which says the liabilities of the partnership shall rank in order of payment as follows. Number 1, those owing to creditors other than partners. 2, those owing to partners other than for capital and profits. 3, those owing to partners in respect of capital. And 4, those owing to partners in respect of profits. Again, this only happens in the case of a dissolution of the partnership, unless there's some agreement otherwise that states how money is to be distributed while the partnership remains alive. And the similar provision in the RUPA is section 807 on 656, which to the same effect basically lays out this order for distributing the assets of the partnership in the process of dissolution, when everything is getting wound down and distributed out, and the partnership is going to cease to exist any longer. Again, these are only at the end of life for the partnership, unless the partners agree otherwise in their partnership agreement. And that leads to the third rule. There's no default provision entitling partners to interim distribution of profits or to compensation for services performed for the partnership. Here I'm looking at UPA section 18 paren F paren on page 620. And it says that no partner is entitled to remuneration for acting in the partnership business. And similarly, RUPA section 401H on 644 says a partner is not entitled to remuneration for services performed for the partnership, except for reasonable compensation for services rendered in winding up the business of the partnership. In other words, while the partnership exists, there's no statutory default rule that provides for distributions during the life of the partnership. There's also no default rule providing for paying partners to work for the partnership, except under the RUPA in connection with winding up. So again, this means that as a practitioner, as a lawyer, you need to make sure your clients understand that unless they build this into the partnership agreement itself, that is, periodic distributions to the partners, or provide for employment of the partners, maybe through an employment contract, there's nothing statutorily that's going to provide that for them. All right. What I've put together here is a fairly dense slide that I think you'll find really useful when you're trying to analyze these particular provisions that we're talking about. So I'm not going to go through every word of it, but for instance, sharing in profits. Under the UPA and the RUPA, there's a presumption that everybody shares equally. And by that, I mean per capita. 5 people, 20% each. Sharing in losses, same provision, same principle. Per capita sharing between partners of losses in the partnership. Distributions we just talked about. It's limited generally to what happens upon dissolution of the partnership. Compensation of partners. Partners don't have an automatic right to remuneration for acting in the partnership business, except in the case of winding up. So again, no automatic entitlement to distributions while the partnership's alive, no entitlement to be paid for work you do for the partnership, except perhaps in the process of winding up. And there are 2 other provisions that I think are self-explanatory regarding interest on capital accounts and ownership of property, which we'll talk about a little bit more in a minute. So let's talk a bit about these default rules. And I'm contrasting these with negotiated, I'll call them customized rules that partners might choose to have. As I see it, a default rule doesn't have to get it right for everyone, or even most of the partnerships, but rather it approximates what most firms would want to have play out in the absence of a written agreement. The default rules also form a good starting point for drafting, which is what you do. So this raises the question, if parties are generally free to draft around or aside from statutory default rules, does it really matter what the default rules say when it comes to allocation of financial rights? I would submit the answer is yes. Basically because you need to get familiar with the default rules in order to actually draft around it, to try to draft, to customize it. Otherwise, you can argue that the default rule remains partially in effect, and this creates some ambiguity. So I think having the default rules is a good way for us to spot the issues that we're going to have to draft or draft around, which we wouldn't necessarily know if we didn't see them spelled out in this sort of statutory setting. I want to move on and talk a little bit about financial contribution. And this is that last point on the slide regarding ownership of property also. Since a partner can contribute cash or property to the firm in the form of equity or lend cash, questions may arise especially if there's no formal agreement as to whether the partner or the partnership owns the property, or indicating the value of a partner's contribution, especially if it's not cash. Determining who owns property the firm uses is a matter of looking at both subjective and objective evidence of intent. The default rules are UPA Section 8, as you'll see in the chart, and RUPA Section 204, down at the bottom of our chart there at the bottom right-hand corner. The UPA provides, in relevant part, that the following is partnership property. All property originally brought into the partnership or purchased later on the account of the partnership, makes sense. Property acquired with partnership funds, unless there's some contrary intention that's manifest in the purchase document, and real estate acquired in the partnership name. Now, the RUPA has somewhat modernized these rather dated references in the UPA, and Section 204 of the RUPA says property is partnership property if it's acquired in the name of the partnership or in the name of a partner or partners if the title instrument indicates that person's capacity as a partner. So real estate gets deeded to Tom Jones, partner of the Jones and Smith partnership. That creates the presumption that it was acquired by the partnership, even though it's initially said to be going to one of the partners. If property is acquired in the name of the partnership by a transfer to the partnership in its name or to one or more of the partners in that capacity, if the partnership is named in the title instrument. Remember, this takes us back to the Patel versus Patel case, where there was a problem because the property was deeded, I believe, to the two parents who were partners instead of being deeded to the two parents as partners of a partnership. Remember, the son was also a partner. He claimed that the parents couldn't do what they said they could do. This is the situation contemplated by Section 204 of the RUPA. There's a presumption that property is partnership property if it was acquired with partnership funds, even if not acquired in the name of the partnership. That's certainly something that would be asserted by the other partners to activate that particular provision. I want to talk a little bit about service contributions and the default rules and implied agreements that relate to service contributions. The partnership statutes recognize that partners may contribute money or property or labor in exchange for an interest in the partnership. And this may consist of what we will call sweat equity. That is, a partner contributes to the venture by doing work. Maybe you're the person who's an expert at construction. You're the one that built the spec house that your other partner financed the construction of. You're still 50-50 partners. Your contribution was labor. So how do you value it? Is this different from compensation a partner might receive who's actually employed by the partnership to provide services? Perhaps, probably. If the parties contribute equal cash to the business, but one partner puts in significant work on top of that, is there an implied agreement that the partner who puts in the effort, the extra effort, is entitled to a greater share of the partnership? What if one partner does all the work and the others are, quote, free riders, end quote? What kind of a compensation scheme incentivizes all partners to maximize the overall profitability of the partnership? I would suggest that if you can come up with the perfect compensation plan, can you actually draft it into an agreement that everybody understands and that a court will enforce if necessary? And these are thorny issues, especially when it comes to labor or property that may be tough to value. So that's something that can be addressed in a well-written partnership agreement, the valuation of a partner's contribution to the partnership, either of labor or property other than cash. I want to move on and talk about the Starr versus Fordham case on page 206. So what's going on in this case? Well, we have a group of lawyers who are working for Foley and Hogue, and they joined up with Kilburn. And the new firm is Kilburn, Fordham, and Starrett. Starr was a partner at Foley, but he was what we'd call a worker bee. He's a partner who's very competent in what he does, bills lots of hours, is extremely valuable in terms of providing the product that the partnership sells. But he's not a rainmaker. That is, a person who goes out and brings in new business. Those are the major distinctions in law firms, even today. So Starr appears to have addressed this up front with an informal assurance from Fordham that, quote, business origination won't be a significant factor, end quote, in determining compensation. Well, despite this understanding, the partnership agreement said that the founding partners, Kilburn, Fordham, and Starrett, get to determine all of the partnership shares. And what does Starr say? Well, I don't like it, he says. And what does Fordham say? Take it or leave it. And Starr says, okay, I'll take it. Starr stays with the firm through 1985, 1986, and he withdraws on December 31, 1986. That was my second year of law school, by the way. Anyway, we don't know why he left, but the firm had profits of $1,605,128 in 1986, and as the end of the year, had over $1.8 million in accounts receivable and work in progress. Everybody knows what accounts receivable is, I assume. It's money that you're owed. Work in progress were cases that they were working on that they hadn't fully billed out yet. So these were in the pipeline, as it were, when he left the firm. So of that money that had been generated, of the actual, I believe the 1.6 million, Starr had generated about $205,000 of it, approximately 11.3%. Now that Starr had left, the old partners award him 6.3% of the 1986 profits and nothing from the accounts receivable and work in progress. Understandably, he's upset. I think everybody would be upset. So how much are we fighting for? I think if you run the calculation on this, you'll see I calculated it to be about $104,000 at issue between him getting what he should have got based on the amount of revenue he generated and what they awarded him, the 6.3%. So looking at the sharing ratios and the profits for 1986, the trial court came up with the following numbers. Fordham was entitled to $451,000, representing 28% of the 1986 profits. Starrett got $451,000 and under 28%. Gurion, $301,000, representing 18.75%. LeClaire, $301,000, again 18.75%, and Starr, $101,000 for his 6.3%. So, what does the trial court do with this? The court basically increases his percentage to 11% based on what we call an implied covenant of good faith and fair dealing. I'm looking at page 208. So how did the court come to that conclusion? How did it come up with justification for essentially rewriting the partnership agreement, as it were, to make the distributions more equitable? The trial court placed the burden of proving the fairness and reasonableness of the allocation on the founding partners. That would be Fordham and Starrett. They are essentially in control based on the numbers they have. They have a percentage of 56%, which gives them a majority in all decisions, and so they have the ability to essentially control the outcome for these lesser partners. So the trial court places the burden of proving fairness on them. The court finds that they had a fiduciary duty to the minority and non-founding partners, who basically have no control over their financial fate. Now remember, when we talked about fiduciary duty, this is a duty imposed on one party vis-a-vis another to represent the separation of ownership from control. The person with control has a fiduciary duty to the person who doesn't have control. In this case, Fordham and Starrett had control over all of the assets of the partnership. Starr, and to a lesser degree, Gurion and LeClaire, have less control. So there's a fiduciary duty placed on the founding partners to make sure this was fair, and we'll talk more about that through the semester. At trial, the founders also argued that something called the business judgment rule allows them leeway to set the sharing percentages. Did the court buy this? No. Since the founders were essentially engaged in self-dealing, they don't enjoy the business judgment rule presumption that they acted in good faith. Oh wait, I guess I should go back and say, what is the business judgment rule? So for those of you who haven't had corporations, the business judgment rule is, in some cases, has been codified, but it's a rebuttable presumption that those who run a business are running it in the best interests of all of those who have a stake in it. So we typically think of it as a board of directors of a corporation having a fiduciary duty to the shareholders and having a business judgment rule presumption that they're doing the right thing. But that business judgment rule presumption can be overcome if you can show, for instance, that the decision-making of those who are acting under the business judgment rule was not unbiased, was not impartial, was not self-dealing. In this case, the court says, because these two folks, Fordham and Starrett, had a vested interest in giving themselves more money than everybody else, they don't get that presumption that they were acting in good faith when they allocated percentages, the sharing ratios. If you look at note 5-1.1 on page 209, it poses some interesting questions. Did the court's interpretation reflect the parties' likely intentions? Good question. Doesn't the agreement clearly grant discretion to the managers despite their obvious conflict of interest? Shouldn't that have been addressed? Don't the partners have the right to waive or not enforce conflicts of interest? Were there representations to plaintiff at the beginning about the basis of his compensation part of this deal? It seems to be referred to continuously as an understanding, but it doesn't seem to have been formalized in the agreement. So why didn't Starr insist on having this this put into the partnership agreement that the fact that he wasn't a rainmaker wouldn't affect his sharing ratios. All questions that weren't answered. Maybe it's in the more detailed record of the case that we don't have, but our authors raised the questions. And again, this is kind of part of the landscape of these agreements that are sometimes not particularly well written. All right, I want to move on, as is becoming our pattern here. We're going to shift to the world of limited partnerships and look at these same types of financial rights. Here's a nice comparison of how the two most recent limited partnership statutes deal with the issues. Again, this is a very dense summary table of how the ULPA and the RULPA in this case compare. I want to focus on three things. How do you become a limited partner? Is it through making contributions or something else? What financial rights do you have as a limited partner? What rights do creditors have, notwithstanding the limited liability you're supposed to enjoy, against the limited partnership and the limited partners with respect to contribution obligations and the limited partnership's distributions back to the partners? To be deemed a partner in a general partnership, there doesn't have to be any formal act other than the person is one of two or more who have voluntarily combined to operate a business for profit as co-owners. You remember that from the first week of class. As we've seen, this is often an after-the-fact, objective determination, especially where the parties have not created a written partnership agreement. Now, by contrast, a limited partnership is an entity that only comes into being as a result of the subjective intention of the parties manifested in the limited partnership filings that you make with the Secretary of State. There's no default rule for characterizing a person as a limited partner after the fact. Under RULPA section 1016, and that's on page 671 if you're curious, a limited partner is simply a person who has been admitted to the partnership as a limited partner pursuant to the partnership agreement. In other words, there has to be a partnership agreement. In every state that recognizes the limited partnership form of doing business, the limited partnership does not come into existence unless or until the partners, typically the general partner, takes the affirmative step of making a formal filing with the state. There's no common law limited partnership, in other words. As for contributions, financial contributions to a limited partnership, as we've learned already, the limited partners are the people who invest in the limited partnership. There's typically a formal offering document, something like a prospectus, explaining to investors what they're investing in, what the limited partnership hopes to achieve from a business standpoint, explaining the risks of the investment, and hopefully giving the investors an idea of how and when profits may be distributed. The next topic is the default right to profits or distributions. Again, we have this funny aspect of trying to impose default rules on an entity that you have to intend to create, but which is far looser in the dictated structure than, say, a corporation. The default rule for sharing profits in a general partnership, as you know, is share and share alike, that is, per capita distribution. Why? We don't allow the presumption that the sweat equity partner is less important than the money partner, at least in terms of sharing the fruits of the labor in a general partnership. That presumption doesn't hold for a limited partnership. Now, limited partnerships are really not about share and share alike, at least as far as the limited partners are concerned. It's about making an investment. So accordingly, RULPA tells us in section 503, page 791, if you want to know, that unless stated otherwise in the limited partnership agreement, profits, losses, and distributions are allocated in accordance with the value contributed by the limited partner as reflected in the records that must be kept pursuant to RULPA Section 105. This allocation of rights based on the value of a limited partner's investment reflects the fundamental difference between general partnerships and limited partnerships. General partnerships are for people combining to do business together because they want to do business together. Limited partnerships are largely vehicles for raising capital, and the general partners of the limited partnership is the one who's raising the capital. This is where the voiceover PowerPoints are inferior to Zoom. I was going to show you a limited partnership agreement, and I'll talk about it a little bit. On the class website, we have a limited partnership agreement. I'm speaking to that agreement right now, and I'm really talking about the financing aspects of that limited partnership agreement. If you look at the agreement, you'll see the setup. It spells out who what the name of the limited partnership is, who the general partner is. It talks about who the limited partners are, because remember, this is a contract among all these people. It talks about admitting new limited partners, and it also talks about the fact that the general partner has decisional control over the decisions of the limited partnership, as we talked about last week. But more apropos of what we're talking about tonight, in Article 3 of the Model Limited Partnership Agreement on our website, it says that the partnership shall have a total capitalization of up to $1,250,000. Each partner shall contribute a sum of $12,500 for each 1% interest in the partnership. And it goes on to talk about the fact that aside from that initial contribution or initial investment, there's a mechanism for soliciting additional investments from the limited partners if the operation needs additional cash because the initial investment wasn't sufficient. And it provides for something called a call notice, where the general partner asks the limited partners to contribute additional money. And if anyone fails to answer that call for additional capital contributions, then that investment may be taken up by the remaining limited partners, whose partnership interest increases to the extent that they take up another limited partner's investment call. And again, this is fairly straightforward, but it shows how money comes into the limited partnership. If there's a need for additional capital, what happens? It also talks about the idea of withdrawing money and distributions from the limited partnership itself, and basically sets down a mechanism for the general partner to determine the amount of any distribution to partners while that limited partnership is in existence. Again, as we saw before, there typically is not a mechanism for distribution of cash under the LPA statute unless it's in the agreement. So I'm going to talk a little bit more about that in the next few minutes, but if you have a chance to go to the website and look at the limited partnership agreement, particularly Articles 3 and 4, you'll see how the limited partnership is capitalized, what happens when someone fails to make an additional capital contribution when it's called by the general partner, and who creates the rules for distributions during the existence of the limited partnership. Again, this is significantly contract driven. Okay, moving on. A couple more provisions on this chart comparing the LPA statutes as to financial rights. Capital contributions are, as you might expect, cash or property. There has the same valuation problems we talked about for a general partner when it comes to valuing non-monetary contributions. Interesting provision that comes up under the LPA statutes is creditors who happen to know that limited partners have made a certain capital contribution commitment and have extended credit to the limited partnership in reliance on that obligation of that limited partner can enforce that contribution obligation on behalf of the creditor, which I think is interesting. As to how and when they learn about that, you might think of the example of a bank who's only going to lend if they know for sure that they've seen written commitments for certain resources to come into the business. Also, moving down into liability for distributions, kind of interesting treatments of this. Under the ULPA, you can't receive a distribution if it's going to basically exceed the value of the net worth of the LPA. In other words, the LPA cannot be insolvent when it makes a distribution. Similar provision under the RULPA, which makes sense. There can't be distributions if it's going to render the limited partnership insolvent. And there are more details regarding the fact that the general partner needs to consent to most distributions under a limited partnership agreement, which makes sense since, as we know, in a limited partnership setting, the general partner has all control, all management, and the limited partners are essentially passive investors in the entity. All right, let's move on and talk a little bit about LLCs, or limited liability companies. So I have another chart similar to the ones that I had for the general partnership and for the limited partnership that spells out the default rules, in this case under the Uniform Limited Liability Company Act, the revised Uniform Limited Liability Company Act, and in this case I added Ohio, which, as I mentioned, has adopted neither of those model LLC laws. The default rule for the sharing of profits and losses differ from the partnership rules in several respects. Under both the UPA and the RUPA, losses are shared equally, profits are shared equally, regardless of the capital contributed, unless the parties otherwise provide in their agreement. As we said before, in the partnership world, profits and losses are allocated on a per capita basis, share and share alike. The Ohio LLC statute addresses the allocation of profits and losses and provides that, unless otherwise agreed, that allocation is based on the value of the members' capital contributions. ULLCA and RULLCA do not address profits and losses directly. Under the ULLCA Section 405A and RULLCA Section 404A, any interim distributions, which the default rule says must be approved by all members, are to be in equal shares. There's no default rule for capital accounts or financial rights of the members if there's no actual distribution. Apparently, the drafters assumed contributions would be equal. And we have an official comment to Section 405 of the ULLCA that I'll look at in a minute. But I just want to run over this chart very quickly. So the default rule of allocation of profits and losses, any distributions made by a LLC before its dissolution and winding up must be in equal shares. Again, that's distinguishing again between distributions made during the life of the LLC and distributions made while it exists. Under RULLCA, again, distributions made before winding up have to be in equal shares, except to the extent necessary to comply with any other transfers effective under any charging order. And then under Ohio law, unless provided in the operating agreement, distributions are proportional to the investment. And we go down and we look at obligations to make contributions. There is no obligation to make a contribution under the ULCA or the RULLCA or Ohio law. There's no mandatory obligation to make any kind of a contribution. What does that mean? That means you have to put it in the operating agreement. The operating agreement is the contract between the members that will spell out who's putting in what money, who's required to put in what money. The other provisions, liability for creditors for unpaid contributions, as we mentioned before, it exists perhaps under the ULLCA and RULLCA provisions, but there's no provision under Ohio law that creates a cause of action for a creditor who's extended credit to a limited liability company based on what he or she believed to be the capital contributions of the LLC members to enforce those provisions. I want to look at the official comment to Section 405 of the ULLCA. In general, official comments to model statutes function as almost like legislative history for statutes, in that it provides some context for the reader, including a court, as to what the drafters were trying to get at by drafting in a certain way. In this case, the comment reads, recognizing the informality of many limited liability companies, this section creates a simple default rule regarding interim distributions. Any interim distributions must be made in equal shares and approved by all members. The rule assumes that profits will be shared equally. Some distributions will constitute a return of contributions that should be shared equally rather than a distribution of profits, and property contributors should have the right to veto any distribution that threatens their return of contributions on liquidation. In the simple case where the members make equal contributions of property or equal contributions of services, those assumptions avoid the necessity of maintaining a complex capital account or determining profits. So this is intended to function, again, as a default rule in the event that the parties have not drafted around this and created some specificity regarding interim distributions. There are a couple of impacts of interim distributions mentioned in this comment. One of them, of course, is that interim distributions have the effect of reducing the overall value of the LLC and therefore can impact what's available for distribution on liquidation of the LLC, making it important that the parties all approve basically the exodus of cash from the business, since it may impact the viability of the business going forward and may impact the available assets on liquidation down the road. The reality is that contributions are not always equal, and therefore it's incumbent on you as a drafter to make sure that the operating agreement may address the need for specific types of interim distributions. So one obvious one is that when you're invested in an LLC, that LLC membership interest may increase in value over time, and you may actually, for tax purposes, be required to recognize that gain and pay taxes on it. If you have no cash, that creates a problem. So it's not uncommon when we draft operating agreements to include a provision for mandatory distributions of cash to members to pay their tax obligations. And you'll see that in some of the operating agreements that we'll look at this semester. In addition to that, the reality may be that members need cash just to live on or for expenses. Again, there's no automatic entitlement to this, so you need to build that into the operating agreement, which of course everybody signs off on and all the members agree to it. And it is usually written in a way that provides that those distributions of cash, whether for taxes or otherwise, can only be made if it does not have the effect of rendering the company insolvent. Same concept that we have in corporation law, that you can't pay out dividends if it's going to render the company insolvent. So that's the only proviso that affects these interim distribution provisions that we write into the operating agreement. But again, this is the drafter's attempt to shed some light on what they're trying to get at with writing this attempt at an interim distribution rule for LLCs. I want to talk a little bit about member contributions. Again, as in a partnership, the capital account is the basic mechanism for determining how much of the LLC a member owns. If you look at note 5-2, number 3 on page 215, you'll see what I'm getting at. Remember, section 401 of the RUPA on page 644 explicitly provides for the establishment of an account that reflects each partner's capital contributions, distributions, allocation of losses, etc. In contrast, there's no default rule or rule at all for capital accounts in the LLC world. But the reality of the similar tax treatment as between LLCs and partnerships has meant that most operating agreements establish capital accounts and sharing ratios similar to partnership agreements as a way for the members to keep track of their interests. You remember early in the semester, we talked about the check the box regulations adopted by the IRS that allows an LLC to elect to be treated for tax purposes as either a corporation or a partnership. And many LLCs choose to be taxed as a partnership. And so we'll see in many of the operating agreements, we have express references to provisions of the Internal Revenue Code that relate to partnership taxation. Now, these tools for keeping track of how much I've invested, how much I've received back, how much my sub-account within the LLC is worth, are purely for accounting and finance and tax purposes. Just because you're taxed or treated as a partnership for tax or accounting purposes doesn't mean you don't still enjoy the limited liability of an LLC. And as a practical matter, this is where some confusion can come up. Your client, or especially your client's accountant, will keep referring to the entity as a partnership, and you will keep referring to the entity as an LLC because you set it up as an LLC. And there's sometimes a disconnect between how it's being treated for tax and financial purposes, how it's being treated for liability purposes. And so oftentimes you need to kind of translate what we're talking about when we call an LLC a partnership. It really is just for tax purposes. I want to make a few more points regarding allocation of financial rights in the LLC context. Again, there's a default statutory rule regarding interim distributions, as we said before, but it's fairly limited and specific to certain circumstances, and it has certain assumptions that don't necessarily apply to every LLC and its members. Once again, it's up to you to draft the operating agreement appropriately to provide for distributions, interim distributions, perhaps for taxes and perhaps also for simply a distribution of excess cash that the company has. There's no default statutory rule regarding additional capital contributions. And as we said before, there's no rule for contributions at all. It has to be spelled out in the operating agreement. And sometimes the operating agreement will include a provision requiring additional contributions of cash upon certain decisions that are made by the members. For instance, if they, after first buying membership units, the members realize they still don't have sufficient capital, either from their investments or from operations, to make the company viable, there may be a capital call. And again, that's not statutory. That's simply a matter of contract. It's a matter that you need to address in the operating agreement. In the absence of language in the operating agreement, can a member simply refuse to contribute more money when it's asked for, thereby causing the LLC to grind to a financial halt? And the answer is yes. If you look at note 5-2, number 2 on page 214, our author discusses several cases that deal with interpretation of the operating agreement where members have been called upon to make additional capital contributions. Vice Chancellor Strine's opinion in the related Westpac case highlights a common issue of liquidity crisis opportunism, meaning unless you have rules that you've written into the operating agreement that provides some protection for especially minority members. It's possible that majority members may take the position that there was a capital call. You, minority member, weren't able to answer that call for whatever reason. I have cash. I'm going to pay your capital call and thereby increase my percentage because I contributed more cash. That is, as you can imagine, an opportunity for possible abuse. There are lots of reasons someone may not be able to make a capital call. And so if you're representing a minority shareholder in an LLC, you want to pay particular attention to those types of provisions that may mandate capital calls and allow other members to step in with cash, take over your client's capital call position, and thereby increase their percentage, decreasing your client's percentage, which is what we're getting at when we talk about liquidity crisis opportunism. All right, tonight's lecture, again, I apologize that it was had to do it this way. I'll put this up on YouTube for everyone to look at. I hope you have a chance to look at it before Wednesday's class. On Wednesday, we're going to get into a little more detail regarding some of the financial elements of LLCs, limited partnerships, and general partnerships, kind of a mini accounting course for those of you who haven't had basic accounting. We'll be talking about balance sheets, cash flow statements, and things like that that are more detailed way of looking at the finances of these entities that we've talked about in very general terms this evening. Thanks for your attention, and I'll talk to you hopefully on Zoom on Wednesday. I'll try to monitor what's going on with the Zoom platform. If there appears to be a problem, I will get word out to everybody, hopefully ahead of time. Thank you.